I'm going to introduce you to my fellow panelists. We have Craig Shirey from Ares, Jeff Levin from Morgan Stanley, Nicole Drapkin from Blue Owl, and then I'm Marisa Murillo with Greenberg Traurig. I'll just I'll open it up actually with, we do feel like there's a little bit of sort of like resetting what the dialogue has been about private credit. And so I'm going to open it up to my panelists to sort of, I think we really want to change the narrative a little bit about some of the misconceptions maybe about the private credit lenders and the players in the market today. So I'll pass it along to Jeff and Nicole.
Okay, great. Well, nice to meet everybody. Thank you for having us. We were joking, we feel a little bit like the redheaded stepchild with everybody kind of making fun of corporate direct lending here.
Should we just give our money back?
Yeah, I mean, maybe. Listen, I think there's been kind of a bunch of broader sea shifts with regards to direct lending and kind of following on some of the trends that we just heard over the course of the last two panels. There's certainly been consolidation. I think there will continue to be consolidation, but there's certainly been bigger and bigger pools of capital raised within the institutional direct corporate lending market, which has led to some fundamental sea shifts with regards to deal flow, the types of transactions that we see, the kind of broader market backdrop. And despite what we saw over the course of 2022 and 2023 with a rising rate environment and the syndicated markets fundamentally shut, so kind of a very, very good vintage with regards to direct lending, even though we have seen spread compression as capital formations come back and as the syndicated markets reopened, we're still seeing very attractive asset level yields with regards to the loans we're originating, with really conservative loan to values in bigger and bigger businesses that are extremely downside protected.
Yeah, I agree with all that. I think from a macro standpoint, I agree that direct lending and private credit will continue to go further and further up market. And if anyone's looking for justification that direct lending is a safe place to deploy capital and generate real premium returns, I think all you really need to do is look at the last couple of years when we all in the private equity community went long capital structures that were designed to borrow money at 7%. And then very quickly, the cost of borrowing ballooned to be 12% plus. So if we were sitting here 4 years ago and you said to me, borrowing costs are going to go to 12+%, I would have said default rates would have spiked dramatically and the percentage of deals in the market that it would have been flipped to pick would have been substantially higher than it is. And so here we are on the other side now, we think, as rates are coming down, portfolios performed, risk returns were strong, the illiquidity premium to the public markets has continued to be between 150 and 300 basis points, and the health of the U.S. middle market or private credit borrowing base, let's call it, will improve now as rates come down. And so I think it's been a really good decade plus of returns. And I think, the asset class made its way through COVID. It made its way through this rate spike. So I'll pause there. Craig, I'm sure you have thoughts as well.
Yeah, no, I think there's 4 or 5 things we can double click on. One is, you think of pre-COVID now, Nicole's point around interest rates. I mean, I think the great news from a liquidity perspective, from a portfolio performance perspective, all of us have seen it. This is a tried and true asset class that has lived various cycles, whether it's performance cycles through COVID. So for example, I know for us pre-COVID, we're 3 times interest coverage. Now we're 1.6, trending towards 2 times. And I think, Jeff hit on a really interesting point. It's like, I would have probably had a similar bet saying how distressed would the portfolio get and how much PIK would actually be required to salvage some liquidity pressures. We're 1.6% PIK for amendment issues. The bulk of our PIK is actually tied to new issue, which if you think about, getting into the private credit versus, BSL, we were the only ones open in the last 2 years. People quickly forget 22, 23. The banks were all shut down. They were hung with deals, Citrix, Nielsen, Twitter. They're still hung with Twitter. So the point being is that we can step in, provide capital solutions in times when it matters most. And then, to the illiquidity premium, the range that Jeff threw, I think, is spot on. But you have to remember that's through various cycles and over, 10 to 20 years. So do you feel times of contraction like we do right now? Absolutely, it's going to happen. But what is the long-term average? What is the long-term outlook? So, I think, we continue to be very bullish, and, the portfolios show it, right? Pre-COVID, 45% loan to value, now 43%. You can go through a variety of metrics of double-digit EBITDA growth. The portfolios are directionally very healthy, and we have a lot more levers to fix problems. And I think we've all focused on sectors that I think are, I'd say, the higher margin, better cash flowing businesses that are much more recession resistant. And we've had private equity guys step in when it mattered and support their companies. So I think that is the benefit where if you're in the bank broker model, you have to take the risk, you have to be in market, and you end up taking risk on things like Twitter, where I guarantee the three of us would look at this and say, I don't even understand the business model. It's interesting, it's neat, but that's not something we'd ever invest in. So I think we have that
To be
luxury.
clear, you saw Twitter and decided to pass on it, I'm sure.
Oh, we did see it. Don't get me wrong. I mean, we took the looky-loo. We browsed.
I think on the default point, this is the key differentiator, is you're going with a private credit solution for a whole host of reasons, but it's our job to see absolutely everything that's in the market, whether it goes private or syndicated. It's why we're going to start to see bifurcation with regards to credit performance amongst the bigger managers where they have bigger pipelines and larger teams, because if there are credit issues, if we don't like a documentation point, we're able to pass on a transaction because there's a healthy pipeline behind it. Whereby, exactly to Craig's point, if you're in the syndicated market, you have to play. You have to play everything. So I think when you think about our portfolios, yes, they're very large. Yes, we have hundreds and hundreds of borrowers. There will be problems. But by and large, we're being paid to pick the better credits, and not only the better credits, but to have better documentation. So if something does go wrong, we're able to kind of step in and have a better realization or kind of a better outcome upon a default if there is one. So I would have agreed. I would have thought there would have been an uptick in defaults or kind of non-accruals in a really meaningful way. And I think some of it just points to the resiliency of some of these portfolios, whereby we're choosing not to participate in a lot of these companies that are over-levered or have kind of thin cash flow metrics.
Because I think one of the points you're getting at was, if you look at just, the sheer M&A and volumes, and people say, oh, M&A feels soft. I mean, net it's up 77% versus last year. Obviously, that was on a low. Nothing's going to compare to 21. But I think the benefit of our platforms is the incumbency, right? So, almost 60% of our new money issuance has come from, existing companies in our platform. So, and the documentation point, I think, is very critical, because, in the seat that I sit in at Ares in capital markets, if you go back 5 years ago to 10 years ago, when we were working alongside to the right side of the banks, you'd see 7 or 8 structural points that they'd put in flex. Now you see 20 to 30, right? So they're managing to the lowest common denominator, where we're sitting here saying, is 250, 500 million, $1 billion per name. These things matter. So what you may be able to get in the BSL market, you definitely can't get here. And then you have teams that we have playbooks that to solve some of the problems as they come up, because invariably they will, right? When you have 500 plus portcos, no one's perfect.
You guys have been sort of dancing around the issue of PIK, and that being, we've talked about documentation a little bit, and so there's been some news lately about PIK being a downside of the sort of direct lending market, and that it may be masking some deeper financial issues with some of the portfolio companies. So maybe you guys can level set on that point as well.
Sure, happy to start, as we've been the target of some of those articles. Listen, PIK is a tool in the portfolio, but to Craig's point, it is not a tool that's used very often with regards to amendment activity or restructuring. Yes, sometimes and very selectively, and it's kind of similar metrics in our portfolio that Craig just cited. PIK is a component of our book in certain aspects, and it tends to be for the biggest and the best credits, where we're able to get a premium that's decided up front based on a relative value trade, underlying kind of fundamental credit aspects of each each borrower where we think that that is appropriate risk-adjusted return for an individual company. So we will use PIK in our book. It comes with a significant premium, and it tends to be the best borrowers across our portfolio. Now the press kind of zeroes in on some of these situations where PIK is a tool. Oftentimes, if there is any form of amendment activity and we're offering some PIK concession, it comes with a fundamentally large equity contribution from a financial sponsor to help delever a balance sheet or continue to help liquidity pressures that a business is facing. That will happen when we think there is a fundamental turnaround that's going on in a business and where we see a path from A to B, not just kind of a kick the can down the road.
And also in terms of like the idea that direct lenders are, you know, in some instances maybe not recognizing a situation that is becoming distressed and maybe finding other ways to mask it. Do you feel like any of that needs to be kind of like?
Yeah, I'm happy to jump on this for the starter also. What is so unique about the direct lending market is, I'm not going to use the cradle to grave analogy either, although it was probably first in corporate direct lending, not in ABF. We know our borrowers inside and out. We are alongside them or alongside a private equity sponsor or founder in a diligence process. We have quarterly, if not more often, monthly and sometimes weekly reporting metrics that kind of go along. We know management teams inside and out, and we're tracking that performance every single quarter. At least at Blue Owl on our credit platform, we have an in-person quarterly portfolio review of absolutely every single name, so 400 some odd borrowers, that's done as a full underwriting team on a quarterly basis. So it's kind of really direct feedback and up-to-date knowledge of what's going on in a business. Listen, across many of our businesses, we're public filers. You can see the marks in our portfolio, and so I think we're taking a very conservative view to kind of where we think things should be appropriately marked over time if we're starting to see stress in underlying borrowers.
I think that's actually a more critical point than a lot of people realize, and having worked on both sides of it. During the telecom bubble, I worked in TMT. We had a $10 billion book at a bank. We had nowhere near the information, and we had nowhere near the access to management, and we had nowhere near the oversight on a more frequent basis than we do in this seat. So to kind of echo some of Nicole's comments, we mark our portfolios quarterly. It's all public. We've obviously been the beneficiary of a entity that did not appropriately mark their book in one of our acquisitions. So it's something that we hold near and dear, and there's obviously been headlines around that. So I think it's people do not appreciate the level of engagement we have with management teams, and rarely are we surprised by something. So you're seeing these things 2 quarters, 3 quarters ahead of time start to have issues. And I think the other thing Nicole's alluding to was that when we do go in and use PIK, away from capital and liquidity injections, there is a dozen levers that we have a playbook to pull in terms of tightening documentation, going in, figuring out, where can we tweak and add value such that there is not additional value erosion, which I think is very important and is something that, is very different than the broadly syndicated markets where you have CLOs that are just, okay, there's kind of faux perceived liquidity. We think we can trade in and out, but a lot of times there's not, because there's only like 10 or 15 names that actually really trade and have true liquidity in those markets. So I think the thing is, we have more levers to pull. And if you look at what has happened more broadly across PE with this kind of, onset of capital markets professionals at the PE shops, some of them have tried to consolidate their relationships with guys like us so that, you're not just in one deal with them, you're in 7 deals, you have $1 billion to $2 billion to $3 billion exposure, and there's very much a portfolio conversation being had, and you're co-investing with their LPs. So there's layers to this that you have to kind of look at it from the inside perspective saying, are they going to do the same things to us in a downturn that they would do to just say the BSL markets or guys that are in, whether it's loans or bonds or whatever, where there may not be relationships there and just purely a trading component.
Yeah, the only point to add, and I agree with everything that Nicole and Craig said, is the tricky part of managing PIK in these portfolios, I would say, is principally twofold. You have on most of these pools of capital in the U.S. at least, we're all using leverage, as you all well know, and there's baskets within those financing lines of how much of the portfolio can actually have PIK securities. So that's something that needs to be managed really carefully, and I think fortunately, sophisticated, large, well-branded managers got ahead of it in terms of negotiating proper terms as rates were rising with their lenders. And then a lot of the direct lending market is BDCs, as Nicole mentioned, and BDCs have to pay out 90% or more of their income. So that's a metric that we all need to manage too carefully. But again, I think this conversation, I think, would have been more interesting probably a year ago when SOFR was at 5.25%, and we had no idea how long it was going to be at that level for, with significant uncertainty around what these portfolios would look like. Now we're at a place in the rate cycle where, again, with rates coming down, this PIK issue really shouldn't be problematic over the next few years as we're on the other side now. So I'm quite bullish in terms of this facet of our business and the risk within the portfolios.
If anything, we've used it as a strategic advantage. I mean, I'll cite a deal that was earlier in the year, Cotivity, which KKR bought, and there was a bank option. And just remember, the banks have to fit it into a box. The box is for CLOs. CLOs tied to ratings, so they could only get X amount of leverage. If you look at the company, good credit, strong LTV, we are providing, it's an apples and oranges conversation. So they can go through 5 times, maybe we can go through 5.5, 6 times, where we can add PIK component to manage liquidity, but that is short-lived, right? So it's reserved for best sponsors with proven track records, with best credits. So this conversation around PIK being, because we have this on our quarterly public calls with the analyst always zeroing in on it. It's like, guys, 1.6% of our entire book has a PIK on it that is tied to some kind of amendment construct, which we definitely made some changes that benefited the outcome of that situation.
Yeah, I mean, I think it's an important point on something like a Cotivity. In every one of these situations now, kind of where the market's evolved to, and you've kind of seen a little bit of a convergence across publics and privates, and it's kind of been talked about so far this morning. We have a direct solution, right? And sometimes we're going to be working together on that. Sometimes we may not be. But on something like that, there was a direct solution that was there. And so, kind of evaluating, on the behalf of a private equity firm, kind of what's in cost of capital versus flexibility versus certainty versus having a few relationship lenders versus something that's more distributed. And that'll kind of be a broader based conversation. But as these markets have evolved, and certainly, over the course of the last 10 years, COVID being a major secular share shift, I think, and then the rate movement being another, it's just a fundamental different conversation to have a few lenders that really know your business, that know your management team, versus something that's a little bit more syndicated, where you may be corralling hundreds of public market investors, nobody that has an ownership stake or a leadership stake in any one particular tranche. And so that's kind of really been part of that kind of secular share shift. And now the markets will go back and forth, and we get refinanced out in the syndicated markets and vice versa. But even in a more muted deal environment that we've certainly seen, albeit up from last year, I mean, the private markets are still doing close to 90% of the LBO volume that's happening in the U.S.
Yeah, I think there's been a lot of press about the growth of the market and how many LBOs are now funded by direct lenders and private credit. It's also very interesting to me, the recent partnerships between traditional banks and private credit funds. And so I wonder if you guys can, kind of give your perspective maybe on why you think those are now starting to happen, if you think they're timely or if you think they're a little late to the game, and where you see them going.
Sure. For us, I mean, I view them as headlines and headlines only. We have, if you go back to, I think when I joined Ares in 2011, they had a partnership with a bank at the time called GE, right? And so these have been around for a while, but maybe said differently, we've been partnering with banks for years. So this, I think, changes nothing. I get what it's about. It's about originations. For our firms, we have scaled originations. We have history with a bunch of these companies. I mean, ironically, bring up Cotivity in a former life. It had a different name. When that deal was originally underwritten, we were backstopping SunTrust at the time, now Truist. So these are ongoing conversations because, the banks know that we are capital solutions providers. And by the way, getting back to the private equity capital markets individuals, like, what is their job? Drive the best terms, reduce risk, and get the deal done in a timely manner, and don't hit a bad market and don't get hung. So what do? You try to bring as much capital to the table. Well, the parity between private credit and the BSL market has never been more that I've seen in my career. You can go get 7 to 8 guys and get a 10 to $15 billion unitranche done. And that didn't exist before, right? So there is the weight of the capital, but if you look at it, you also have to go kind of individual investment bank by investment bank, right? Because everyone has a different flavor, right? Goldman has a private credit business, Morgan Stanley has a private credit business, but they approach it very differently. The City Apollo situation, right? No surprise, a lot of very senior officials at Apollo are ex-Citi guys, right? But we've had conversations with Citi when they sold their middle market book. This was going back 4 or 5 years ago. So I listen, good for them. I think if you peel the onion back and look at what they're trying to do when you have that much capital, go find opportunities. But I think for, at least I'll speak for myself, I think it may resonate with others, is when you have the originations, it's less pressure to go find those partners. So what's really coming out of those relationships that we're not going to get a call on anyway, right? So the sponsors already have the relationships and understand our history, our behavior in good, bad, whatnot.
Yeah, look, I like working within a investment bank affiliated asset manager. So our asset management business is $1.5 trillion. Obviously, we're wholly owned by Morgan Stanley, though. I think to Craig's point, I think the partnerships they make great headlines. They make some really interesting conversations with LPs. I think they're really hard to make quite successful for an extended period of time. I think they create origination optionality. That's the point. But I think getting the alignment of interest is really hard. Why? Bankers want to deploy capital for the sake of their clients' benefit to win fee business, right? And so getting an alignment with how you manage the counterparties is really hard. The bankers are going to want to say yes to every deal that comes through. The private credit manager providing the capital that has complete discretion on how that money gets invested is going to want to be really selective. So there's a tension there. So the question would be, with a private credit manager that has one of these partnerships, are they doing some deals up front that are dicier to get some points on the board for the sake of, quote, being a good partner? I think that's a real risk. And then when you go through the deal spectrum, so origination, very hard to get coordinated and be responsive. As responsive as you could be by just going to Blue Owl, ourselves, or someone like Ares where there's no extra layer. And then through the diligence process as well, a banker is going to want to shield their client from an in-depth diligence process that the private credit manager is going to want to do, right? And so there's that misalignment as well. And then on the portfolio management side as well, should a credit go poorly, the banker is not going to want to have a difficult lender within the capital structure pressing the management team, so on and so forth. You all get it. So I think it makes great headlines. I think it's really hard. I think it does create optionality. But most partnerships in the market have a very finite life. We'll see how it plays out. Take the City Apollo dynamic. I think it's the buy-in from the top of both firms is great. It means there's more skin in the game than otherwise. But rewind a day before that partnership was inked, Citi could show Apollo or the three of us transactions. Right? There's nothing new to that. The investment banks are always trying to insert themselves into this ecosystem to find borrowers, find capital, and skim a fee where they can. Right? So nothing's really changed. There's a little bit more coordination and organization around it. Within our business, I would never want to manage a private credit platform that was solely reliant on the Morgan Stanley Investment Bank to source. The Morgan Stanley Investment Bank is a phenomenal set of relationships that we do leverage. Absolutely, we partner with them all the time, but we have our own 75-person dedicated team to our business. So the combination is really powerful, but we're under the same roof, which is very different. So I'm sure you have thoughts.
I would love the Morgan Stanley Investment Bank to show us deals. No, I listen. I think it's a really good point.
They probably do, and don't tell me.
Listen, it's access to diligence and the fee scheme, I think, are the two things to kind of really hit on, to be beholden to one chain. I understand why some of the smaller managers are doing it where you don't have the direct team that's going out, right? Craig's team's probably bigger than mine, but we have 130 people solely focused just on direct lending, corporate direct lending, primarily within the financial sponsor channel, but not entirely. I'm never relying on an investment bank to do my diligence for me. If I am, my LPs shouldn't be investing with us. They should be going somewhere else. And then more than that, right, a lot of the kind of flexibility and the way we're able to drive increased returns is exactly by showing up with a full source solution. I don't need an intermediary in there to structure something for me, to fund it for me, to have that back office operations, to trade it, or to do any of these things that kind of result in that fee scheme, which is just more expensive to the end borrower. And so I think some of them are exactly unique headlines. I do think they'll drive some volume for some period of time. It'll probably be.
I think that's an interesting point, though, because I kind of view it as a little bit of silver lining, where we've been trying to penetrate. If you think about it, and I think Jeff was doing a great job of kind of outlining what the process is. Who's closest to the company? The bankers. Okay. So first round, maybe they do something with one of us, maybe they do it with Apollo. The interesting thing we've seen with, whether it's mostly with the non-sponsored side, is these management teams get real fast, real quick. So what do? They start trying to figure out and be Mr. Capital Markets themselves. So then they start to realize, wait, I know these guys, they have a reputation. So now if I'm looking at it, I think it's a win for all of us in the sense that now you're just bringing more access to non-sponsor companies to get this type of capital and not just be like, oh, we have to go get a 2 times levered bank deal that like it has a lot of amort in it, but it's cheaper, right? They know they have options. So I think if anything, it just drives awareness and, helps us penetrate different parts of the market that I think net could be a win for us.
Yeah, I think the one last thing to add, like Ares or Blue Owl's portfolio, we don't have investment bankers. We're not in the M&A flows. We touch a lot of the M&A flows because we're getting asked for leverage rates on a lot of stuff before it kind of hits the market broadly. But we do have hundreds of individual borrowers in our portfolio companies. And so that is value differentiating even in itself. If I have XYZ sponsor that's looking at buying an HVAC servicer, I've had 9 in my portfolio for 8 years. We know the management teams, we know the industry, the end markets that they operate, the geographies, et cetera. And so that really is a value differentiator, even though it's kind of not this broader bank partnership where you may have the M&A inflow. Sorry.
No, I think I agree with what Craig said. I think on the non-sponsored side, it's more interesting and will create more optionality for private credit managers through these bank partnerships. On the sponsor side, the value that I see, and I live this with our bankers, is just the number of tentacles that an investment bank has into private equity firms. There's a Morgan Stanley professional, arguably, in the offices of countless buyout firms every single day talking about equity capital markets, M&A, industry coverage, whatever it may be. So that mind share is really helpful. I just get back to the point of when you're inside the house like we are, I think it's really interesting. When you're outside the house, I just think that coordination is really, really tough. But I also think, though, if you think about where the private equity ecosystem was 25 years ago, versus where it is today. So the number of publicly traded companies has declined dramatically over that period of time. I think we're in a similar place within the early innings of private credit growth. Ultimately, we'll continue to take more and more share from the syndicated loan market. And what that looks like, if we said 10 years ago that Ares and Blue Owl will be the size that they are now, I think everyone would have bet against that, and here we are. They're massive managers, right?
We didn't exist 10 years ago. So.
Exactly, yeah. But I think so these bank partnerships are now very topical, but we'll see how this all plays out. I think it's still really early. I mean, the incestuous nature of our business with the insurance segment stepping into the private credit ecosystem, we're a bond issuer and a private placement issuer. Ares' insurance arm is an investor in our paper. And Morgan Stanley, within the fixed income department, lends to both Ares and Blue Owl. I'm certain of that. And so it's fascinating how intertwined it all is. But again, I'm really bullish on where we are now, given what's happening with rates and what happened with defaults. And then I think if we're on this panel in another 5 years, I think what we're going to find is the private credit market owns a even larger percentage of the large cap sub-investment grade debt world. Will there be maybe some liquidity in those names? I don't know. Time will tell. I think it's challenging for a bunch of reasons, but I'll pause there.
I definitely want to open it up to questions. So definitely if there are things that we haven't answered for you guys, let us know. But I also want to touch on one other thing, which is we've been, very passionate about direct lending and private credit, but the elephant in the room has been M&A deal flow, and the sort of at the same time that all of these amazing things are happening and the market share for direct lenders has gone up, the M&A flow activity has not been what we expected, I think, for 2024. So I wanted to open that up to you guys as well. How is that impacting you guys? What will you expect to see in 2025? What could make that better?
Yeah, I'll kick it off here. I think if you look at our past 3 quarters, we've on average had about $10 billion of deployment. We're on pace for a record deployment. I think I mentioned a stat earlier, 55%, 60% of that is, incumbencies. So while headline is, yes, it's M&A is better than last year, it's still, I think to your point, I think we did expect more. The great news is rates are coming down, which should spur M&A. And then more importantly, I think the number I read was there's $3 trillion of PE assets that need to trade. So we've played the continuation vehicle game. We've played the minority interest game. The sponsors are trying to figure out, I think Joel said it best on the DPI, right? Disappointing. The point being is that there's a ton of pressure for return of capital, and it's going to have to manifest somehow. And we think next year, we'll get past this election. There's a lot of companies that need to do something and a lot of funds that need to return money. So we're waiting.
Yeah, I mean, I'd echo that. We've had 3 of our biggest origination quarters as a platform throughout 2024 and expect that to continue in the back half of the year. Yes, would love more M&A volume just because I think it'll alleviate a little bit of the spread compression we're seeing with lack of deal flow. But there's been a tremendous amount of refinancing, a lot of movement from the syndicated market or BSL market into our market. That doesn't get as many headlines as the other way around. But a phenomenal amount of deal flow that's driven by add-ons within incumbencies and existing portfolio companies. I do think we're starting to see some green shoots, so a bunch of new processes that are launched. I don't think those will get done in 2024, but hopefully sometime in 2025. And I do think you're going to have to see, on behalf of some of the sponsors, they're going to have to sacrifice some IRR to return capital. And so that should lead to a bunch of new activity in 2025 as well.
So we have a question. Maybe I'll open it up to Craig. How large are the teams that monitor each of the investments, and how many credits or entities does the team member focus on? And do you know early on when a default is likely?
So just from a team monitoring perspective, I think Nicole hit it earlier, cradle to grave. We do not break out originations versus underwriting. So that's one team, and they stay with it from origination to workout. But from a purely portfolio management perspective, I think we have a team of 35 to 40 individuals that, some of which have been at Ares 15 plus years, so been through multiple cycles, and then understand all the different playbooks that we have applied in a variety of different end markets and companies with different sponsors. And on the default side, I mentioned this earlier, we are rarely surprised by an issue. So the point being is that we see the issues happening early, and when we spend the 4 days every quarter going through them, these things are pressed. There's a ton of EBITDA analysis. There's a ton of downside analysis. We're going through all of these. I mean, I think that's a thing that maybe not be appreciated by people is like we're doing the analysis ourselves and it's monitored very closely, but we get a ton of inbounds from a lot of our investors, which keeps everyone. It's kind of a secondary focus on all of the portfolio as well. So that is ongoing every single day, right? And so when amendments come up, hey, for example, for us, it's with some of the new documentation things that are made into the market. We're drilling down on these companies' documents and saying, okay, we have a page in our memos that says, listen, do we have this, and this protection? Okay, we don't have it, get it, right? So you're coming to us, we're gonna come back with an ask.
Yeah, the other point I'd highlight is the number of portfolio companies and all the information that we are seeing on a monthly or quarterly basis. That's a huge asset to us as we deploy new capital, right? So we're seeing how these middle market businesses are performing in various environments and what the pressures are and the pain points. And so we obviously take that into account as we make new investments.
It looks like we're short on time, so maybe it'll be like a speed round. So if today was October 2019, what do you guys feel like you got wrong or underappreciated? I'll start with you, Nicole.
I don't think got wrong. I think, appreciating how law firms, well, not you specifically, but will create creativity within documents and kind of really understanding where some of those loopholes are has always been a focus, but kind of a little bit more of a downside focus going into going into a higher rate environment. And that's probably the biggest one.
Yeah, I think I think the market got the rate expectations wrong. I don't think any of us thought that SOFR would go to the place that it did. If we had known that in 2019, we would not have put as much leverage on these businesses, and the private equity firms wouldn't have either. I mean, the transfer of value over the last few years from private equity to private credit has been astounding. Fortunately, given everything we've said today, we're on the other side of that now. But that was the biggest miss, I would say. If you look at the downside cases where we run scenarios in these financial models where you assume rates spike, I don't think anyone was at 5 to 6%.
You also didn't have a COVID downside either, probably.
No, we did. We did.
I think the one thing away from what they're saying, which I completely agree with, the lawfare construct is a problem, which I think we're all collectively trying to fight. In rates, obviously, but the thing I think, we underappreciated is just the sheer weight of retail capital. I mean, right now, like we've mentioned here, is just the arms race. The reason I joined Ares, because I came from a middle market bank, was if you can't beat them, join them. And so I felt that was the beginning of the arms race, but I didn't fully appreciate that it just could continue to crescendo the way it has.
Yeah, and I think I agree with Nicole. I think documentation, we probably underestimated it as an ex-Kirkland lawyer. I think that some of the provisions that were put in, yeah.
You didn't
said it, we
didn't.
I think there were provisions that were put in under the idea that maybe people wanted flexibility, and that was always the conversation point, but not necessarily that a lot of these things would ever be used. And I think now that some of we've seen over the last few years, post-COVID, the impact of some of the things that I think were novel maybe 5 years ago, it'll be kind of interesting to see how documentation actually moves so that people are aware of what the impact of certain covenants or certain baskets and stuff are. So we'll see kind of how that goes. Last question, and I don't know if anyone in particular is more focused on Europe or the UK, but that's a question we're getting.
I think we're
there. So.
Yeah, I mean, we just raised a large fund, another fund there. I think we were one of the first direct lenders there. Going back many years. I think, said differently, as one of the incumbents, it's obviously a focus for us, but I think they're behind us maybe 5 to 7 years in terms of just the sheer capital raise. So what I hear from my colleagues over there is just the amount of funds that are starting and the competition that's happening. So I think if anything, more capital is going to flow there, more opportunity for private lenders like us. It just, good news, bad news, right?
Yeah, we're there as well. We hired one of the founders of Arcmont about 3 years ago, and so we've built out a business around him. But I agree. I think the opportunity there is interesting. The capital formation, to Craig's point, on the retail side has been much more pronounced in the U.S. than in Europe to date, but I think that will evolve and that will grow over time as well.